Have you ever felt unsure about how to start investing, or felt like your past investments didn't go as planned? Maybe you're just beginning your investment journey or have made some mistakes along the way that left you frustrated. Well, you're not alone. Many beginners face similar hurdles, but the good news is that knowing what to avoid can set you up for success. In today's video, we'll dive into the top 8 beginner-friendly investment mistakes that many make. If you can recognize and avoid these, your investment journey can be much smoother. Stick around until the end to learn about the most costly mistake that can easily be avoided. Let's get started. 1. Not figuring out your investing style early on. Starting your investment journey without understanding your investing style can lead to confusion and poor decisions. It's essential to know your risk tolerance and long-term goals before diving in. Some people prefer low-risk investments that grow steadily, while others are comfortable taking on more risk for potentially higher returns. Understanding where you fall on the spectrum will guide your decisions and keep you focused on investments that suit your financial situation. To figure out your risk tolerance, there are plenty of online questionnaires that can help assess your comfort level with risk. Once you know whether you're conservative, moderate, or aggressive with your investments, you'll be able to select the right types of investments for you. Investing in assets that don't align with your risk tolerance can lead to emotional decision-making, which might cause unnecessary panic during market downturns. Understanding your investment style helps you stay focused, allowing your money to grow over time without stress. 2. Owning too many investment accounts. It's tempting to open multiple investment accounts, especially when you're just getting started, but this can quickly become a hassle. Having too many accounts can make it harder to track investments, and the fees for each one can add up over time. Consolidating accounts into one or two places can reduce confusion and save you money on unnecessary fees. Having multiple brokerage or retirement accounts can lead to paying several administration fees, reducing your overall returns. If you don't keep track of all your accounts, it can be easy to forget about some, leading to missed opportunities. The key is simplifying and consolidating your accounts into a manageable number, ensuring you have a clear picture of your financial situation. When accounts are consolidated, it's easier to monitor performance and make informed decisions. Using fewer accounts also allows you to avoid unnecessary paperwork and reduce the chances of overlooking fees. This simple step helps streamline your investments and makes managing them much easier. 3. Ignoring your super retirement account. Many beginners, especially in the early stages of their careers, make the mistake of ignoring their retirement accounts. It's easy to focus on immediate goals and overlook the long-term importance of superannuation or retirement accounts. These accounts are specifically designed to grow your wealth for retirement, and the earlier you start contributing, the better. By leaving your retirement accounts in a low-risk, balanced portfolio, you may miss out on opportunities for higher returns. If you're young and have decades until retirement, it makes sense to take more risks with your portfolio. This can involve shifting to a high-growth option that focuses on assets like stocks and property. While these options carry more risk, they also have the potential for greater rewards over time. Starting early and contributing consistently to your retirement accounts can set you up for a comfortable future. The longer you wait, the more you may have to contribute later to catch up. Adjusting your retirement strategy according to your age and goals is essential for maximizing growth and securing your future. 4. Expecting steady, predictable returns. A common mistake many beginners make is expecting a smooth, predictable ride in the stock market. Many believe that the market will consistently provide 8 to 10% annual returns based on historical averages. However, the market can be volatile, with ups and downs along the way. These fluctuations can often lead to stress and poor decision-making if expectations aren't set properly. Market downturns are normal, and investors need to understand that long-term growth is a goal, not short-term consistency. Stock prices can drop during a downturn, but they usually recover over time. If you're in it for the long haul, staying invested during volatile periods can help you come out ahead in the future. Instead of expecting steady returns, it's important to embrace market fluctuations. The key is to stay focused on your long-term goals and avoid making hasty decisions based on short-term movements. By doing so, your investments will have time to grow and recover, leading to higher returns over time. 5. letting emotion control your investment decisions. It's easy to let emotions drive investment decisions, especially when the market is volatile. Fear, greed, and excitement can all cloud judgment, leading to costly mistakes. For example, many investors panic during a market downturn and sell their investments at a loss, only to watch the market rebound shortly after. Others might chase high-performing stocks during a bull run, taking on too much risk. The key to avoiding emotional decision-making is to stick to a well-thought-out investment strategy. When markets are down, it's important to resist the temptation to sell and instead focus on your long-term goals. Likewise, during market booms, stay disciplined and avoid chasing trends without proper research. Remaining calm and rational during market fluctuations is essential for long-term success. Emotions can be powerful, but by following a strategy based on logic and research, you can avoid costly mistakes and keep your investments on track. 6. Fear of market downturns. One of the most common mistakes beginners make is letting the fear of market downturns prevent them from investing. The stock market is cyclical, and downturns are inevitable. But instead of avoiding the market during tough times, it's better to see these downturns as opportunities to buy valuable stocks at lower prices. Investors who hold on to their investments during market drops tend to see their portfolios recover over time. Instead of panicking, the focus should be on purchasing more shares when the market is down, ensuring that future growth benefits from buying at a discount. Dollar cost averaging or consistently investing the same amount of money over time can help mitigate risks and make the most of these market fluctuations. Don't let fear hold you back from taking advantage of market corrections. When managed well, downturns can present the best opportunities to build wealth. The key is to maintain a long-term view and use market volatility to your advantage. 7. Not contributing enough to retirement accounts. Retirement savings are vital, and the earlier you start, the more you benefit from compounding. A common mistake is failing to prioritize retirement accounts early on in the investment journey. These accounts, such as 401k, IRAs, or Roth IRAs, offer significant tax benefits, and the earlier you contribute, the more your money can grow. Many people are tempted to invest in individual stocks or other assets, neglecting their retirement accounts in the process. However, retirement accounts should be a top priority, as they provide tax advantages that individual investments do not. Contributing consistently to these accounts ensures that you'll be financially secure in the future, even if market conditions fluctuate. If retirement savings aren't prioritized, it can lead to a shortfall later in life, forcing people to work longer or live with less financial security. By starting early and contributing regularly, it's possible to build a substantial nest egg for retirement. Make retirement a priority, and watch your wealth grow with the power of compound interest. 8. Following the herd. It's natural to want to follow trends, especially when everyone around you is talking about a hot new stock or investment. However, this herd mentality can often lead to poor decisions. When everyone is raving about a particular stock or cryptocurrency, it's important to take a step back and assess whether it truly aligns with your goals and risk tolerance. Investing based on what others are doing, without understanding the risks, can lead to significant losses. Many people fall into this trap when they see others making money and feel the pressure to get in on the action. This can be especially dangerous when following speculative investments like cryptocurrencies or hot stocks that have yet to prove themselves. Instead of following the crowd, do your own research and make decisions based on sound reasoning and logic. Investing is a long-term journey, and making informed decisions will always yield better results than following trends. Trust your instincts and avoid the herd mentality to stay on track with your goals. That's it for today's video. These are the top 8 beginner-friendly investment mistakes that many make and how to avoid them. By understanding these common pitfalls and applying these lessons, you'll be well on your way to making smarter financial decisions and achieving long-term growth. If this video helped you, don't forget to give a thumbs up, share it with your friends, and subscribe to the channel for more tips. And if you're ready to take the next step in your investment journey, check out the video linked here for more advice. Thanks for watching, and I'll see you in the next one.